Please give a warm welcome to the stage, Axios senior business reporter, Hope King.
Hello, everyone. It's so great to be here with you. Our third Axios BFD NYC. This is where it all started, and we are so pleased that you can make the time for us this afternoon. Before we get to our next conversation, I do want to tease that we have an event here tomorrow as well on the future of women's healthcare. And I would love to just give you a brief overview of that event, which will feature angel investor and activist Hannah Bronfman, Agenda founder and former ABC News chief medical correspondent, Dr. Jennifer Ashton, and more. So if you'd like to be here again tomorrow, we'd love to see you. Please find an Axios staff member. They'll be wearing a pin with the blue A, and they'll give you more details. All right, without further ado, I am incredibly excited for our next conversation. This is a person that we've wanted here on our stage for a very long time. She has been at the helm of one of the world's largest stock exchanges since 2017, at which point she made history as the first woman ever to lead a global exchange. Please put your hands together to welcome the Nasdaq CEO and Chair, Adena Friedman. Welcome.
Thank you, Hope.
Thank you.
That was very nice.
Great to have you with us.
Oh, it's great to be here.
So, first question, are you paying interns now? You started as an unpaid intern. So
we are paying interns now.
Okay, great.
Yes.
That was a very important question that I wanted to get with you, because you've been with Nasdaq for so long and you've seen the trajectory of companies. You've got a lot of conversations that you've heard backstage that you kind of want to respond to. Before we get there, though, I do kind of want to start with just where are the IPOs? I mean, we're still down about 71% in terms of the absolute number of IPOs since pre-pandemic 2019.
Yeah, well, I would say that the IPOs are starting to resurface a bit. You're seeing healthcare coming back into the markets, and you're seeing good and warm investor reaction to more recent healthcare IPOs, which is excellent to see. That's a big part of the portfolio that we have at Nasdaq, so pretty excited about that. But when it comes to tech IPOs and other industries, but let's focus on tech, software companies, there are two things that they're focused on. One, they want to be able to show a whole year of improved performance over 2022 and 2023 so they can demonstrate, because 2024 has been a better year for software sales. So they want to have 12 months of really strong performance before they start to think about coming out into the public markets. The second is that the cost of capital environment has made it so that companies, those that are relying on capital to continue to grow their businesses, are definitely trading at a discount. So the markets themselves, everyone's thinking, oh, the index is up, so therefore the markets are up. And yes, the index and the markets are up. But it's a little bit of a tale of two cities between large cap, which has done very well, and you can kind of see in the S&P 500 you have kind of a 10% kind of valuation increase in the large caps. But if you look at the S&P small cap index, they're actually down 10%. So, it's been a little bit of a tale of two cities. And when a lot of companies come out, if they're coming out, let's say that they have $500 million of revenue and they're growing really fast, and maybe they're cash flow neutral or even somewhat cash flow positive, great company to take public, but you want to come out on a high note. So you want to have a strong earnings. You want to see the cost of capital, which means the interest rates in the economy kind of continue to trickle down. And therefore, I think that creates a really interesting environment to go public. So we do anticipate more IPOs as we get into 2025.
Do you think that the presidential election year is a factor in all of this?
Well,
people are waiting to... Yeah,
I mean, now it is. I wouldn't say the whole year is, but the fourth quarter tends to get a little quiet in an election year. And that's a normal reaction where you don't want to be going out into the road, on the road, and you want to talk about your company, but you're talking about an environment that frankly you can't control. So you want to wait for that to happen, and therefore then you'll know when you go on the road what environment you're operating in. And investors are more ready to take risk in an environment where they have a known environment as well.
And you mentioned the market concentration, right, and that big caps, and especially the Mag 7 stocks, and the effect that has on the overall market. Do you think that there is a market concentration risk right now that investors are missing out on opportunities elsewhere?
I personally think that there's a real reason why those top companies are doing, are performing as well in the markets, because they're performing well in their earnings. So one of the things I've been looking at is over the last 5 years, so since pre-pandemic, kind of mid-2019, what have the markets done? And then what have the companies in different sizes done? So like large cap, mid cap, small cap, because it really helps you understand what's really happening, because there are not a lot of companies that have come out that are truly large cap. So those would be 30 billion plus billion dollar companies. If you look at the large cap companies, and you'll see kind of the companies in the Nasdaq 100, for instance, we're up Nasdaq 100 is up like 150% since pre-pandemic, but the earnings of the companies that are on the Nasdaq 100 are up 110%. So meaning the earnings profile of those companies is spectacular. And then if you look at kind of the mid-cap companies, you're looking at like the broader index, which would be, I would say S&P 500 has large cap, mid-cap. They're up about 80%. The companies that are listed on them are up like 50% in earnings, right? Whereas the small cap index, the broader small cap index, the index is up about 50%, but the company earnings are up about 35%. And one of the things to think about is debt service. Large cap companies, we all fix our debt. We have long-term debt. We've been able to really ride out this higher interest rate environment pretty well. But small cap companies have really struggled because they generally have more variable interest rate debt, shorter dated debt. So they're having to refinance in a much higher interest rate environment. So the percentage of debt service to EBITDA or EBIT has gone way up. It's about 40% for small caps, whereas it's around 12% for large caps. So you have to realize the environment has been a challenging environment for a lot of companies, but the index itself is weighted towards larger companies for good reason. The larger getting larger, and therefore public investors are doing quite well. But we have to recognize that companies are still waiting for a better cost of capital environment.
Well, we've been hearing all day, too, that private investors are doing quite well, and they're quite happy to have their companies stay private for longer. What do you think the economic and sort of consumer impacts are when companies stay private for longer? I mean, the IPO used to be like the exit, right? You have the party, you have the bell ringings, you have all the ceremonies, and it seems like that is not what companies are ultimately driving toward, at least in the shorter term as they have.
Yeah, I mean, in the current environment. So we've always said that there's a symbiotic relationship between the private markets and the public markets. There are times in a company's life where it makes sense to be private. As they're growing and expanding, they may not have a predictable path to the future. So therefore, it's hard for them to kind of put themselves, or hard for investors to underwrite the future of that business because there's a lot of unpredictability to it. That's a company that's best left with private investors who are there to really help shepherd that company and help it grow. And then there are other times in a company's life where they want to transform, and that's an opportunity for them to go into the private markets as well through private equity. But then the public markets are there because it's such an important part of the economic development of the country. I mean, if you think about it, number one, I heard before from the gentleman from Lightspeed that a lot of value creation has occurred in the public markets, and we'll talk about that in a minute. But that value creation accrues to the benefit of hundreds of millions of people here in this country, right? If you have, essentially, we looked at it, and about more than 50% of the population in the United States is invested in equities, either directly or through mutual funds. If those equities are not in the hands of, if they're not in the public markets and they're not investable by these people, well, then they don't get the benefit of that value creation. And that's an important part of helping the entire economy grow, helping the consumers grow their wealth, manage their lives, and have financial success. And so I do think it's important to recognize what the public markets are there for and why it's so important for companies to embrace being public at the right times in their lives. But there are times when it skews one way or the other. And often you have a huge swing in the cost of capital, interest rates. So that's made it very difficult for public investors to predict the future of a company, which makes them more risk off. And then you also have companies where there's a lot of money continuing to flow into the private markets, which means that they can continue to capture that value creation in the private markets. But that keeps that value creation in the hands of fewer people. And I think that's one thing that we have to kind of consider. As the interest rate environment abates and we get a more normalized and balanced cost of capital, I think you're going to see that the public markets become more attractive. And I also want to say the last thing we always focus on is regulation. Like, let's make it so that going public is not such a huge feat that it makes it so it becomes an unattractive way for a company to live its life. We're a public company. I really like being a public company, but it is a different existence than being a private company. So how do we help companies make a smoother transition? That's what Nasdaq's for. How does the government make it so that it's not so onerous to be a public company? That's a policy. Those are policy changes that we're hoping to work with the government on.
So what are you doing to help companies go public? I mean, the cost is really high for somebody, an entity that hasn't had to make the kind of public disclosures to have the right staff, but at your level, what are you doing to try to help that process?
Within Nasdaq, we focus on a few areas. We focus for companies themselves. We focus on helping them develop relationships, a healthy relationship with investors. So we have a whole suite of investor relations services. They're the biggest in the world. We have thousands of companies who we work with around the world on that. And then we also help them manage those disclosures. There are a lot of new disclosures that have come out around ESG. And so how do we help them gather up all that information and map it out to all the taxonomies and rating agencies and investor groups that really want to understand the ESG profile of a company. And then the third thing is around governance. There's a lot that a company has to do to really professionalize its governance as they go public, get more independent board members, manage their board meetings in a more professional way. And we have a whole suite of technology solutions and services that help them modernize and professionalize their boards.
Not only do you have the pressures of now, the allure of staying private for longer, the Texas Stock Exchange is set to launch in 2026. What are you doing to prepare to compete for listings that may be attracted to the offerings there?
Well, first of all, we operate in an incredibly competitive environment today, right? So people think of, we have two obviously very large and scaled listing exchanges, but there have been other exchanges that have tried to crack into the listings business. And it's a difficult thing to crack into. We provide a whole plethora of capabilities to our clients. Great for, as you've said, a great first day, and we have an enormous amount of capital investment in what we've created in New York to make for a great day. But we also take that on the road and do remote opens and do great activations around the world. We do a lot to help our companies market their companies and rebrand as public companies, both to an investor audience and to support their consumers and their businesses. We also provide, as I mentioned, a whole suite of capabilities, and those are all offered as part of our package for the first few years that they're public. So we've done a ton to invest in creating an amazing experience for companies as they move themselves into public markets. It's hard to compete with, honestly, but we take every competitor seriously. And then on the trading side, because if you're going to launch an exchange, you have to be both trading and listings. On the trading side, we compete with a whole slew of other exchanges. So it is a dogfight for every order that comes into our market. People think that when you list, where you list is where you trade, but that's not the case at all. So there are about 13 venues that trade, exchange venues that trade U.S. equities, and then about 30 dark pools that trade U.S. equities. So it's a highly competitive business. We know how to compete well, and we're ready for any competitor that comes along.
Okay, well, I do have to bring this up because Governor Abbott of Texas said that the New York area is losing its grip on capital markets. How do you react to that?
I think New York, everyone knows, New York is a wonderful place. I mean, the whole country is a great place for capital creation. I don't think, obviously New York is the center of the markets in the United States, but the whole country is a country of capital creation. We have this innovation ecosystem that is unmatched in the world. We get companies, or people from countries all over the world asking how we can recreate what's special about the US. So I don't like to look at it from one city to another. I like to look at what we've created here in the United States and how special it is. How do we continue to make sure that we continue to support the kind of innovation that we have here in the United States? It's such a critical component of what makes us special.
Let's move away from public listings as an exit and just deal making overall in M&A. You're now coming up to the 1-year anniversary of the Adena deal, which was made during a pretty rough year last year. Are the pressures right now of going public and getting deals done the same, and how are they different?
Well, we've talked about going public, so we'll talk about the acquisition landscape. So we did a very significant deal last year. We bought a company called Adena from Thoma Bravo for $10 billion. We announced that deal in June of 2023. Right as interest rates were kind of hitting a peak, and it was what I would call a risk-on trade in a risk-off environment. So we had incredible conviction that this was the right next step for Nasdaq. We're just so proud of what we've been able to do.
Largest deal in Nasdaq's history.
It is, and we've been over the last year. We've kind of had 3 key pillars: integrate, innovate, and accelerate. So how do we integrate it successfully? How do we make sure we're innovating constantly within all of Nasdaq, but including the products that we acquired? And then how do we make sure we accelerate growth and expand the business and expand the opportunity for all of Nasdaq, but including the products in Adenza? And I think 1 year out, we feel great about where we stand. But it is a different environment. I've done M&A now since 2004, so 20 years of doing an M&A at Nasdaq, and with a 3-year break, but 17 out of the 20 doing deals. And it is a different environment. The regulatory process is very different today than it was, let's say, 20 years ago. And I would say that we have to be very mindful that we are very fortunate to be subject to the DOJ, not the FTC. But
why are you very fortunate? Why is that a fortunate?
Well, it's a little bit more. It was a little bit more of a standard process. We closed the deal in 5 months, so I think that's a more standard process. But a lot of companies who are having to go through the FTC, it's a non-standard process today. And I do think that the FTC has, if you're not careful, the antitrust process can have a huge chilling effect on the entire innovation ecosystem. People think about it as being, oh, let's make sure the large don't get larger. But what it's really doing is hurting valuations at the very beginning of a company's life. Because if you're a VC investor and you are thinking about investing in an innovator that has no track record, that has very little business, and you're taking a big risk on that business, the first thing that investors think about is, how am I going to exit? I did work at Carlyle for 3 years. So when I sat in on the investment committees, it was all about the exit. So I think that if you only have one path to exit, which is the public markets, and you don't have a viable path for acquisition, you're not going to underwrite the risk with the same level of capital. And I think that is something that's missed here on the atypical approach that we're seeing within the FTC could have a ripple down effect on actually being willing to underwrite risk at the very beginning of these innovators' lives. Because you have to give them the opportunity to find different ways and paths forward as they grow and expand their business, get acquired, go public. Those two options, those two doors, you want to make sure are still open. And I do have concerns about, as much as I'd like them all to go public, I think it is very important to have the options as early in a company's life.
So what you're suggesting is that if an investor sees that there will be regulatory hurdles down the line, they will be less inclined to take those risks earlier on, therefore then removing some of the opportunities for younger companies to start.
I would say that it makes it harder for younger companies to get financed if the investors are not there to ready to commit capital because they think that they only have one exit opportunity. I think it's not obviously happening right away, but as I've been listening to a lot of private investors and their concerns about the exits of their portfolio, they're very concerned that they both don't have the door open on acquisition and they don't have a great door open right now on going public. And so it makes it so that they're kind of stuck and therefore the companies stay on their portfolio for longer, which then lengthens out, kind of the return cycle and other things. So I do think that it ultimately will have a trickle-down effect if we continue to have a very atypical antitrust environment.
You've made trips to Washington. What's been your message?
Very clearly that this is not a good long-term plan for the health and the benefit of the U.S. economy. I go to Washington to focus on two things. One is to make sure our innovation ecosystem stays the best in the world. And there's so much on the policy side that's important there. And the second is to make sure the public markets are the best in the world. And again, there's a lot of opportunity to improve there too.
All right.
Well, so those are the two things that we tend to focus on. And antitrust is a part of that conversation.
Well, the chair isn't here, but Lena Khan has said in the past that these efficiencies don't really materialize ultimately, and that it really becomes actually an inflationary pressure. What are your responses to that? I mean, she's clearly looking out for the broader consumer and not a set of very accredited investors.
Yeah, I think the first thing is we've had a very short-term period of inflation, but over the last 15 to 20 years, inflation has stayed extremely low, which has allowed the country to maintain a very low cost of capital for over 20 years. So I'm not so sure that on the macro basis that we're seeing that. She may be responding to a very short-term situation, which has nothing to do with acquisitions. It has everything to do with other factors in the economy right now.
So we've talked a lot about where we are. Let's talk about where we are going in the last segment of our conversation. I hate to ask, but I have to ask, which is, what do you expect for the deal-making environment to be post-election?
Oh, I hadn't expected that question. I think that the M&A environment, I can only say this. I don't know because we don't know who's going to be, what the administration is going to look like. I wouldn't give you two scenarios, but I would say that we've seen, a lot of change in the way that M&A is considered in the last, let's say, 10 to 20 years. So I think that every administration has its own take on that. I do think that big tech continues to be a focus area for both candidates. So I think that unfortunately will continue to be an area that will remain in focus. But beyond that, I think it's going to be I don't think it's necessarily going to be the top of mind thing for either candidate. But I can't predict that.
Just the sentiment, I guess, overall in the rooms that you're in.
Not a lot of focus on that particular question, so I don't have a crisp answer to that.
From where you sit, how would you grade the economy?
I actually think the economy has been remarkably resilient, and I think that the consumer has been remarkably resilient. I think that despite the fact that all these disruptions, whether it's supply chain, geopolitical, COVID, other things, the corporate environment has been really, really strong. So we do have a little bit of a tale of two cities, and as I mentioned, large cap, small cap. I think we have a tale of two cities in the population as well. There are people who've been really resilient and people are really starting to struggle. And I think we have to recognize that the cost of capital is quite constrictive right now, but it has been resilient. The cost of capital, which means the interest rate, the difference between the interest rate and the inflation rate is quite high. So we have to start to bring that down, to bring that in line. And I think if we can do that gracefully over the next few quarters, we could actually have a continued run of a pretty strong economy going forward. So that soft landing does feel like it could in fact occur.
I mean, the dichotomy in sentiment and reality of earnings and what the markets have been doing, right? Just new records even last week. If there is such a dichotomy, then what is the best way to really judge the accuracy of this question of how healthy is the U.S. economy? Yeah,
I think that, well, first of all, there's an enormous amount of data out there. And when I think about it, I think about, obviously, you think about the ability for consumers to continue what their spending power is, what their confidence is. Very important to look at consumer confidence. You also want to make sure that you're looking at employment, because if unemployment ticks up considerably in a short period of time, that can have a big effect on consumer confidence. Consumer confidence is definitely a huge underpinning of our economy. And then I think you also look at things like manufacturing and other kind of production-oriented stats that help you understand the core economy much better. But those things are all running in the right direction right now. They're kind of showing that that soft landing is a real possibility. It's not, you can't say it's over until you kind of feel like you're in a normalized interest rate environment for a period of time, and you can kind of see how the economy's fared. But so far, I feel like we're continuing to chug along, even with a lot of disruption around us.
All right, one fun question to end things, and you can actually have a choice between answering one of these two. You have a second-degree black belt in Taekwondo. In order to achieve this, you have to break boards with 2 kick techniques and use different legs, if I'm not mistaken, because I just looked it up. So is that right?
Okay.
Whose face do you picture when you were practicing? Or what has it taught you about deal making?
Okay. Well, first of all, in our test, we had to fight 2 people at once.
So did you pick?
So you have to
2 pictures or 2
exactly.
people's faces?
So the first degree black belt, you fight 1 person, and you do have to break boards. But then the second one, you have to fight 2 people at once. So I don't tend to visualize faces. That's not my thing. I tend to focus solely on survival. So I would say in the case of fighting 2 people at once, the best offense is a good defense, right? So you want to make sure you just stay on defense. Now, when it comes to M&A, however, I always say that one of the great things about Taekwondo is you do have to focus on offense and defense simultaneously. Being a CEO, you always have to focus on offense and defense simultaneously. But with M&A, that's kind of among the biggest risks you're going to take as a company and as a CEO. So you have to be ready to take that offensive step. You have to look defensively to know what the tail risk is of making that step. But when you go in, have conviction, be ready, and go all in. And that's the way I look at how
If this were a different show, we would end this with a kick. But Adena, thank you so much for being with us. We're taking a quick break. Stay with us. Thanks so much. Thanks, Adena.
Thank you.